Hello everyone. So today's class was all about financial market. As you can see, we have the whole description of financial market we have already done about the concept of financial market, and now we are on the topic of your classification of financial market. We have two types, that is capital market and money market. The first one we have to discuss, that is money market today. Now what is this money market all about? As you can see, this money market, it is basically a short term securities. Short term means less than 1 year. Okay, and what happened here, it is regarded also as a close substitute for money. Okay, and that is why it is called near money instrument. You can see the statement, that is near money instrument. Okay, that is because it is very close to money. It can be easily converted. It is readily in a liquid form available. Okay, why? Because it is less than 1 year. It can be matured in less than 1 year. Now what are the features of money market? You can see it is having the maturity period of less than or equal to 1 year, so it can be easily in a cash form available. Next, it is unsecured. It is not secured basically, but it is having low risk and highly liquid short term funds because it can be easily converted into cash forms. Thirdly, it is used by the people, the companies, institutions, for meeting their temporary cash shortages. Whatever temporarily they have some cash problems, they are meted out with this type of market, that is money market. Now what are the major people involved in this is that the RBI, the commercial banks, the other type of companies of finance, and some corporate houses plus mutual banks, mutual funds also. So these are the people involved in the money market dealings. So next is your instruments. So we have basically 5 instruments in front of us. The first one is Treasury Bill. Now as you can see, the Treasury Bill, Treasury is coming from the government. So what happens, Government of India issues it in the name of, or you can say RBI on behalf of Government of India issues the Treasury Bills. They are again the short term borrowings of the Government of India. They are basically by the Government of India. That's why the name is Treasury, because they are by Government of India. They are having less than same period, that is 1 year, less than we have the period, and the RBI issues in the behalf of central government. And basically they are highly liquid instruments. They are easily redeemed and they are in a liquid form available. Then that is why they are also known as zero coupon bonds. Why? Because they are having very low risk and they also assured a return. Like for example, we have issued 1 lakh rupees. So we will be getting this 1 lakh rupees, the face value of that 1 lakh rupees of treasury bills. When we just buy them, they are sold by the government by, suppose, less, means the discounted price like 96,000, and when we will get back the money, we'll get 1 lakh whole. It means that 4,000 rupees is the discounted money as a return, or you can say benefit for us. So this is very good in a liquid form. Plus the minimum value available for these type of fund is like 25,000, and they can be multiples of that. So minimum 25,000 you can avail it. Okay, and the treasury bills are varying from the days. The maturity days are from 14 days to 364 days. They have this much of maturity period. This was all about the treasury bill. Next is your call money. Now call money, when you can see the telephone is here, means we're not calling and just asking the money, but basically call money means that we generally call the money, demand the money, and it is easily paid also, but it is for the 15 days only. Maximum day period is maturity period 15 days only, 1 day to 15 days. And this is used not by the people, it is used by the banks. Actually what happens, banks have to maintain their cash reserve ratio, and if suppose they don't have this much of cash, they take it from the other banks. They borrow from the other banks on a particular interest, and that is known as call rates. Now one more important element is there is inverse relationship exists between the call rate and the other mediums. Now what happened, when the call rates are higher, they will not borrow this bank, you can say money from the other banks, because the rates are higher. In this situation what will happen, we will have an inverse relationship, that when the call rates are increasing, the demand for that call money will be decreased, because we would be borrowing from the banks will borrow from the other sources. That's why they have an inverse relationship. Okay, so now the third one, it's your commercial paper. Now commercial paper, you can see it is all about like unsecured. It was first introduced in 1990, and basically it is just like a promissory note. Okay, a promissory note, and it is maximum for 1 year, ranging from 15 days to 1 year. Basically what happened, the big concern, big companies and all, they use it for bridging their finance. Bridging means building the gap between the finance, like to meet the flotation cost. Now what is the flotation cost here? What happened? See, basically they have taken long term finances from the different sources, maybe for 5 or 10 years, and for those sources they need money. Raising that money means, maybe like suppose I need an application for those sources, I am just means whatever between small costs are there, they are meted out by these commercial papers, because these fund can be duly completed by the business concerns on time. So that is why, to just meet out those flotation cost of between of the borrowing, long term borrowings, they take commercial paper as a borrowing. Okay, fourthly, we have commercial bills. Now what is this commercial bills? As you can see, bill, it is just like bill of exchange you have done in accountancy. It's a negotiable instrument, just treated like, suppose I have taken a bill from my customer and there's a time period because I need money at the same situation. This bill is given to again the bankers, and bank give the money. It is just like that only. It's just like bill of exchange, and whenever the time period of the maturity of the customer's bill is done, the bankers take from there. Same way here we also have the drawer and drawee, which all the transactions we have done in accountancy. Last is certificate of deposit. Now it is what? It is actually issued by commercial banks, institutions and all these concerns to the people. You can see the certificate deposit by these people, and what happened, they are actually issued in tight liquidity by the commercial banks, because they want to meet their general needs. Okay, basically they are from 91 days to 1 year. Okay, and banks are not allowed to discount these instruments. These instruments cannot be discounted, means this cannot be refunded by the banks. Okay, thank you.